What is up, everybody? We are going to be going over equilibrium today. Today's Saturday. I wanted to get this video up on the weekend, and I'll probably get a video up tomorrow. I'm not sure what video it will be. We'll probably go over SMT divergence tomorrow after this video. Again, I don't know when you're watching this, but again, it'll be the next video after this. But again, I want to go over equilibrium today. I had this question in my Discord the other day when people were trying to watch these videos. What you need to do when you're watching these videos. I am going over how to identify these concepts right now, right? And these continuation confluences and stuff like that, like fair value gaps, equilibrium, SMTs, break of structure, all that stuff. Right now in these videos, if you're up to this point, the whole main point of these videos is to determine how you can identify these conformations or confluences in the live markets, correct? When we get into the later videos down the series, I'm going to be making a video about putting all these confluences together called strategy creation, okay? And I'm going to show you guys and girls how to use them correctly with the right time frames, what time frames I personally use, all that stuff. I'm going to give you guys all this free sauce for free, okay? It's basically just what works best for me. We've already explained this 100 times in this series. You probably heard me say it already. But again, the main goal of these videos is to help you identify these confirmations or confluences, whatever the hell you want to call them, in the live market. So when we do go over strategy creation, you guys and girls can go perfect them to the way what works best for you, okay? When you develop these systems, everybody, like, it's crazy on social media because people act like they create all these confluences and all this stuff and inverse fair value gaps, liquidities. Let's be realistic here. That stuff has been created a long time ago. Everybody just puts their own name on top of it and they sell their course and they do this and they do that. I'm here to just show you the real way to identify these confluences. And then once you guys are done watching this series, you can watch my live trade recaps. You can watch my live trading sessions. You can watch all that stuff. You can ask questions in the free Discord. Then you develop your own system over time, okay? What works best for you works best for you. You use these confluences to determine how the market moves and stuff like that. And again, you'll start to trade live over time. You'll get more experience and you'll start to look at the markets differently than everybody else. We all see the markets different. We all have different entries. We all have different risk. We all have different emotions, all that stuff. Okay, you start to develop your own system over time using the same confluences. You can be the same trader basically like somebody else using the same confluences, but take different entries, trade at different times, do different things. There's a whole bunch of shit you can do in the stock market, okay? So again, right now, if you're at this point in this video, the main point when we go over equilibrium, when we go over fair value gaps, when we go over liquidity sweeps, I want you to identify them first. You can go back and back test those, and learn it. That's it. Learn it, identify it, and then we'll start using it in the live markets. Okay? So let's jump into equilibrium. This should be a pretty simple video. Equilibrium is pretty simple. And again, we'll show you guys and girls how you identify it. Then your job should be after this to go back and back test it for 30 minutes to an hour every single night until you understand it, and then we'll keep moving forward on these videos. All right, let's jump into it. Coming into equilibrium, same thing like all my other videos, just make it simple for you guys and girls. I'm going to go over the definition first, which you see on the left-hand corner. Pause the video, listen to me read it, blah, blah, blah. Write it down in your notebook, okay? So you understand what equilibrium is. Then we'll go over how to identify equilibrium. Then we'll show some examples in the chart. And then you guys and girls are on your own and you can go back and study it as much as you want, okay? So equilibrium. Equilibrium is the midpoint of a defined price range, typically measured from a significant high to a significant low. It represents a zone of a fair value where neither buyers or sellers have a strong advantage. Below equilibrium is the discounted price range, where price is considered cheap relative to the range and higher probability long positions are favored. Again, this is if we're marking out equilibrium, if we're trying to continue in a long trend or something like that, or in a bullish trend, correct? We'll go over a bearish trend also. Above equilibrium is the premium price range, where price is considered expensive relative to the range. Holy shit, guys and girls, remember I have dyslexia, okay? So I'm not the best reader. And higher probability shorts positions are favored. In practice, equilibrium is commonly identified using the 50% level of the range, with premium and discount defined by the upper and lower halves of the range. Traders use this framework to align entries with directional bias rather than chasing price at unfavorable levels, okay? Read it, write it down, reread it, because again, I am not the best reader in the world. All right, I'll put it out there. Sometimes I see things a little backwards, but that's okay. That's why we're good at trading. Apparently, people with dyslexia are good at trading. Look it up, okay? I don't know, that might be wrong. I'm just talking. Okay, so again, I'm about to delete this. I'm gonna shut up. All right, goodbye. All right, so let's go over a bullish trend, right? So what we're gonna use for equilibrium, you are gonna get out your GAN box, okay? The tool should be over here in the left-hand corner. Where is it? Right here, right? In the Fibonacci area, it says GAN down below. It's called GAN box. I have it favorited up in my tool section, as you guys and girls can see up here. But again, I'll give you guys the settings real quick. Let's go over the settings. Here's my settings. Screenshot them, write them down. You can copy the same colors if you want. Make sure you pay attention to the checked boxes and the unchecked boxes. Do whatever you want with it. Okay, screenshot it, write it down, and delete it. Cool, problem solved. This is what your GAN box should look like. Personally, this is what mine look like. You might have the boxes on the side and stuff like that, or the lines on the side. I took them off because, again, it gets in the way of the chart. This is how I like mine to look. Nice and simple. Red line in the middle, gray top, bottom. Doesn't get in the way, okay? Now you know what equilibrium is, right? It's a GAN box, but how do we use it? Okay, so if we are in an uptrend, what does an uptrend consist of? Correct? It consists of higher highs and higher lows, all right? So if we are marking out equilibrium in a bullish trend, what are we going to mark it out from? From the most recent low to the most recent high, right? So we have our most recent low here. We'll take it all the way up to the most recent high, correct? What are we looking for? We are looking for price to come down below the 50% level. And since we are in a bullish trend, this means that the bottom level of equilibrium underneath the 50% level, this is going to be discounted price range. Okay, so we'll put a D here. Let's put a D for discount. Discount, and then this is premium up top. On. We'll put a P up here. P, premium. Just like that. So this is discounted price range, and this is premium price range. Why do we want price to come down in a discounted price range? Because it gives us a better entry for our long position to play out, correct? We want to take price in discounted price range. We'll use for an example. You walk into a car dealership. Let's say you're checking online. You want to buy a BMW M3 because everybody's obsessed with those, I guess, especially in the trading community. You want to buy a BMW M3, correct? You see online that the average sticker price for them is like, let's say $100,000. You walk into a dealership and they have it at a discounted price on Black Friday or something like that, and they're selling it for $85,000, right? $15,000 off sticker. Would you buy that car if you had that $100,000 originally walking into the dealership to buy that $100,000 car? Yeah, probably. You'd probably buy it from that dealership because, again, they have a discount on it, right? Or let's say you walk into that dealership and the sticker price is usually $100,000. Let's say price is in the premium area, right? And they're selling the car for $110,000 to $115,000. Are you going to walk out of that dealership and go look for a better price? Or are you going to just purchase that right there and say, all right, I have the money to purchase it. I know these cars are cheaper. It doesn't bother me. I'm going to buy it for a more expensive price and be okay with that. What would you rather prefer? You'd rather prefer the discounted price, right? So put that in your mind for this example. We are waiting for price to come back into discounted price range. And in the bullish scenario, the bottom part of the 50% level is discounted. And then the top part is premium. So we want price to come back down into discounted and take a trade scaling down to the lower time frames, which we'll use our continuation confluence like fair value gap fill, equilibrium, which we're using. And then if we get a reaction off of equilibrium, a bullish reaction, we could take our entry, put our stop loss below where equilibrium would get invalidated if we're using that as our continuation confluence, and target our draws and liquidity above, correct? But again, if price doesn't come down into equilibrium, and we're using this as a continuation confluence, we don't have a fair value gap or anything that's getting filled, we are just going to let price run without us because we don't want to see price. We don't want to get an entry at a higher level and then price ends up coming back down all the way back into equilibrium, sweeping out our lows where we had our stop loss or something like that, and then continue higher, correct? So we wait for price to come beneath the 50% level into discounted price range. We'll scale down to our lower time frames, which will explain the strategy creation. I just want you to identify what equilibrium is right now. And then we wait for price to come to discounted price range. We take our trade, get a better entry, and we continue price higher, correct? So let's go over it one more time. Make sure you write the D and the P in your notebook, guys, for discounted and premium. That's what I'm writing them for right now. It's discounted and premium, correct? Let's go over another example on the bullish trend. Let's say we already went over this one, right? We didn't get an entry. Price didn't come into equilibrium. Price ends up coming back up, right? What are we going to look for? We're going to go from our most recent low to our most recent high in a bullish trend, and we're going to wait for price to do what? Come down into discounted price range, get a bullish reaction out of it, get our entry, put our stop loss below where equilibrium will get invalidated, which would be below this low. It should be a protected low if we're in an uptrend, correct? Because we move in lower highs and lower lows. And then we take our trade, target our draws and liquidity above, okay? That is in a bullish trend, all right? Make sure you write that down. In a bearish trend, it is literally going to be the opposite, okay? So we are going to go from the most recent high to the most recent low because a downtrend moves in lower lows and lower highs, correct? So if we were going to mark out equilibrium on this little line chart, we'd go from the most recent high to the most recent low, correct? And then this is where it's a little bit different, and you got to remember it. When we're in a bearish trend, this is discounted price range, and this is premium. Again, that's how I just treat it, okay? I treat this as discounted price range because, again, this is where we're going to get a better entry, and this is premium. So it's the opposite. right? In a bullish trend, the lower part is discounted and the higher part's premium. But again, if we're in a downtrend, the discounted part is going to be the top above 50% level and the premium part's going to be below the 50% level, okay? Same thing. What are we going to wait for? We are going to wait for price to retrace back into our discounted price range, and then we'll scale down to the lower time frames. Or if we're already scaled down to the lower time frame, and let's say we have equilibrium and we have like a fair value gap right here, right? Like a nice bearish fair value gap, a 1 minute bearish fair value gap, and let's say we get a bearish candle closure out of this 1 minute bearish fair value gap, and then a bearish candle closure out of equilibrium, which will be back below the 50% level, correct? It has to be a bearish candle closure below the 50% level. So the candle would have to close like this. Look, let's draw it. Below, correct? Showing that we're respecting a discounted price range, correct? If the candle doesn't close below, and let's say we have a wick through, let's say the candle wicks through, but we end up closing under here, right? But we're still in this fair value gap, that we're not respecting discounted price range yet. We want to wait for that candle closure below the 50% level, and same with the bullish trend, correct? With the bearish trend, we want that candle closure below the 50% level, showing us that it's respecting discounted price range and we're getting a reaction out of that area of sellers. And then in a bullish scenario, we want a bullish candle closure after price dips into equilibrium, gets a bullish candle closure out of equilibrium. That shows us that buyers are stepping in, correct? And respecting the discounted price range. Let's go into the charts now. All right, let's go to the 15-minute time frame. This is what you guys and girls are going to go back and review just like this. Go back and back test this to understand what equilibrium is. So let's say we're on the 15-minute time frame and we're technically looking for a 15-minute entry. What we're going to do, if we are in a bullish trend, we go from the low to the high. If we are in a bearish trend, we go from the high to the low. All right. So let's see here. We broke structure to the upside in the 15-minute time frame. Remember, it has to be a low, right? What is a low? We've already went over this video in the beginning of the series. A low consists of a bearish candle and a bullish candle. What is a high? A bullish candle and a bearish candle, correct? So right here is a good example. This isn't where we're going to mark equilibrium from on the 15-minute time frame. Where is our low? Our most recent low is this bearish candle close and then this bullish candle close, correct? So we'd go from this low to our most recent high. What happens? Price comes up. We form our high. What do? We come back down into discounted price range. And what do we also have here? We also have a 15-minute bullish fair value gap. So we have a 15-minute bullish fair value gap also. Let's put this in replay mode. Hold on. I got to go back and select the bar a little bit. What do we get? Price comes down into equilibrium. Comes into the 15-minute fair value gap. We could scale down to the lower time frames here. What do we get? What do we literally get? Even if you went down to the 5-minute, we'd probably scale down to the 1 minute though. We'd scale down to the 1 minute time frame. We can see price comes up, reacts off of it. Again, this is a little bit of choppy price action, but we see even on the 5-minute. What do? We come down into equilibrium. We come into this 15-minute fair value gap. Is this a bullish candle closure above it? No. Is this a bullish candle closure above it? No. When do we get it? Bang, right there. And we get a break of structure to the upside. Boom, entry. Again, this is off of a 15-minute time frame, so this would be a huge stop. But again, we're just showing this for examples right now. And then price will continue higher, take out your draws and liquidity above, and do what it's supposed to do. Correct? Again, you wouldn't enter off of the 15-minute time frame probably, but I'm just trying to show you guys and girls for example. Correct? Let's go to the hourly time frame. Let's find another spot. We're still in replay mode. Let's try and find a bearish equilibrium that gets respected. We have another bullish right here. Literally, look, that's all you gotta do. From the most recent low to the most recent high. What does price do? Comes back down into equilibrium, get a bullish reaction out of it, price continues higher, correct? Let's find a bearish reaction. Same thing here. Go from the most recent high to the most recent low. Does price come into equilibrium? Comes into equilibrium. Do we get a bearish candle closure out of these areas? Nope. We're just tagging into it. When do we get a bearish candle closure? Bang, right here. Price continues down for a little bit. Pretty simple. Let's go to the 5-minute time frame. What do we got here? The most recent low to the most recent high. When does price come back down into equilibrium? We come back down to equilibrium. We get a close. We get a bearish candle closure out of it. Let's just say, hypothetically, we're entering the 5-minute time frame. Entry, draws and liquidity will target above. This is our stop loss where equilibrium gets invalidated. Boom, target our draws and liquidity above. I'm pretty sure it probably continues up higher. Let's see if it does. Okay, it doesn't. But again, we're doing this to understand what is that. We're doing this to understand how to identify equilibrium, and we'll put it together. We'll put the puzzle pieces together. I promise. Just trust me right now with doing this. Let's go to the 30-minute time frame. 30-minute time frame. Let's look for a bearish one. I want to see a bearish equilibrium. All right, we can see bearish equilibrium right here. We go from the most recent low, our most recent high to the most recent low right here. What does price do? Price comes down. It comes back up. It's respecting equilibrium, and then it dumps. Okay, do we just see the overall of how it could work? right? Again, is this going to get respected every single time, 100% of the time? No, it's trading. But again, it's a good continuation confluence to use, and a price and an area where price can come up and react off of, and then we use our other continuation confluences to identify if it is going to have the probability of continuing in the direction we want it to, correct? And that's what you have to put into your mind. Is this going to work 100% of the time? Some people will try this and be like, oh my God, equilibrium didn't work. It didn't work. And it's just like so stupid. Sometimes it's not going to work. That's why we add our other confluences on top of it to make the probability higher of the trade playing out. But even sometimes the trade might not play out. That's part of it. But we can see it obviously reacts off of these levels in some cases. It really does. No matter what time frame you're on. Let's try and find another one. Let's go on the 4-hour time frame. You know what? Actually, let's even go into the daily. Let's go to the daily time frame. Let me take this stupid select bar off. Let's go overall higher time frame. Look. If we're in a bullish trend. Look, we're obviously in a bullish trend. We break structure to the upside. Most recent low to the most recent high. Look, all the way up here. We have these highs up here. What does price do? Comes back down. Comes in equilibrium. Get a bullish candle closure. We get a reaction up. Like this is the case where, like, let's say we're getting our daily bias and we're on the daily time frame. We see prices approaching equilibrium on the daily time frame. We scale down. We see we have a 4-hour low or something like that in this area. We sweep out a 4-hour low. We break structure in the 5-minute time frame. We respect the 5-minute fair value gap. We scale down to the 1-minute time frame. We target our draws and liquidity above, and we're reacting off of a daily equilibrium. Like, it's like, again, we use these tools, and then we use the other tools to identify if it's going to continue in the direction, right? Let's go to the 4-hour time frame. What happens? Let's look for a bearish equilibrium. Let's see if we can find bearish. Look, here's a case where price never comes back into equilibrium, right? This is why we wouldn't enter here, but it comes into this fair value gap and still reacts down. Let's go here. Look, most recent high to the most recent low. What happens? Price trades back up into discounted price range, right? And then we get a reaction down off of it. Like, guys, it's like, you could say it's all made up and shit, but it works. Okay? Like, the market reacts off of these levels for a reason. Price comes back up into discounted price range. The market makers get a cheaper price, and they'll push price in the continued direction that the overall trend's going. Because, again, we are in a downtrend. Price usually retraces back up into that 50% level of that overall range in the downtrend because, again, it moves in lower lows and lower highs, right? And then a bullish trend moves in higher highs and higher lows, and we always try and look for that 50% level to get respected, scale down, use our continuation confluences, which I'm going to show you, and price continues in the overall direction, okay? So you should be able to identify equilibrium. Does that mean you're going to get it right away? No, it doesn't mean you're going to get it right away, but it means you should be able to go back on the charts like I'm doing right now. Use the 4-hour, the 1-hour, the 30-minute, the 15-minute time frame. Identify your equilibrium levels. Look, if we go from the most recent low to the most recent high, we are in a bullish trend. You can just look at price. You can look at price. We are in a bullish trend here. We're moving in higher lows and higher highs. But what does price do here? From the most recent low to the most recent high. Trades back into equilibrium on the 4-hour time frame. Comes into a 4-hour bullish fair value gap. We'd scale down to the lower time frames on the session we're trading. You can use this as a daily bias. Say, hey, price might respect 50% level here of equilibrium. We'll scale down to the lower time frames. 5-minute break of structure after that 4-hour fair value gap was filled. Have draws and liquidity up above. We're continuing on the 5-minute time frame. Scale down to the lower time frame, the 1-minute time frame. Look for a 1-minute fair value gap, 1-minute equilibrium fill. Look for a continuation confluence of the overall higher time frame trend, right? We could see it works. And I'm just picking random times in the chart. This is what you guys and girls should do also. You just pick random times in the chart. Look, we'll go back. I don't know if equilibrium gets hit here. Go from the most recent low to the most recent high. We'll go right here. I don't think it gets hit. It almost comes down and hits it. But again, we can come back down even from the most recent most recent low. I hate my magnet. To the most recent high. What does price do? It comes back into equilibrium. We get a reaction off of the equilibrium level. We continue higher. Like, guys, it's pretty simple, and this should be enough to show you examples. Look at Tundra sleeping back there. Look at her, upside down, rough life. But it should be pretty simple after watching this video to understand that equilibrium can actually work. Again, are we just entering trades based off of equilibrium? No, I'm not going to tell you that we're just going to freaking enter off of equilibrium every time. We use our other confirmations that I'm showing you guys and girls, like fair value gaps, inverse fair value gaps, break of structure, liquidity sweeps, S&Ts. Once you put all the puzzle pieces together, your probability of your trade ends up being higher of playing out, okay? Does that mean it's going to play out every single day? And this is the hard part to, put into everybody's brain that gets into trading. No. Sometimes A+ setups aren't going to play out. Sometimes you have losing days, losing weeks, losing months, and that's where risk management's going to come in. We're going to go over how to handle losses, how to overall just set a system and a rule system. We're going to go over all that stuff, I promise. But again, we're just going over how to identify these. You guys and girls should be able to go back, go on FX Replay, go back on TradingView, and just identify equilibrium. Learn. When you're forward testing in the markets in the morning and you're on a demo account, identify equilibrium. See if price reacts off of those areas. Try and set trades up off of it on a demo account. Don't just start right away with real money or try and prop firm accounts. Start with demo. Identify these things in the live market and go back and study these confluences every single night so they start clicking in your brain when you see them in the live market every single day. Pretty cool. Again, that's how you understand equilibrium. Hopefully I make sense in these videos and you guys and girls enjoy these. So do me a favor, like and subscribe, and we'll keep getting these videos up for the trading roadmap. We got a couple more videos left. I think we have like 9 or 10 videos left. I got this little notepad in front of me right now. But yeah, I'm going to shut up. UFC fights are about to turn on. I got to watch these UFC fights. Well, it just started. All right, I'm watching the UFC fights. I still got to edit this video too. So again, have a good day. We'll see what happens in the UFC fights, and we'll get that other video up tomorrow. All right, peace out.